It seems that more and more chief executives have to run businesses looking at geopolitics. Now, you met with the president and the prime minister. How does, trade and all of these geopolitics actually affect your business?
Well, that was a highly constructive meeting. It was really looking at business opportunities between the UK and the US. There are long historic, many UK businesses heavily invested in the US, and we were obviously a US company heavily invested, across Europe, and so it was just looking at ways that we could do more business, look at future trading opportunities. So net, I'd say highly constructive.
But how does trade tensions affect your business? Does it affect clients, markets, and actually operationally, does it change anything?
Well, trade is obviously the big story right now, and if you look at the speed with which sentiment has shifted, if we were sitting here 4 or 6 weeks ago, the expectation would be that a China trade deal between the US and China was going to happen. Obviously, sentiment has shifted. I wouldn't say that's dead yet. Obviously, the two presidents are going to be meeting at the G20 meetings, and let's see what happens. And as quickly as sentiment can shift one, shift the other. But look at the impact on markets over that. If we were sitting here at the end of last year, interest rate outlook in the US, the Fed still on a cycle of raising, and obviously in a very, very different position. So the geopolitics obviously impacts markets in a significant way, changes sentiment, and hence changes business conditions.
Do you worry about a recessionary environment coupled with central banks that actually just don't have the tools to deal with it?
Well, obviously that's the big talk right now. The yield curve has inverted, and if you look back over time, when the yield curve inverts, more often than not you get a recession, but not always, and we should emphasize that point, not always. You typically get, and in fact you pretty much always get rapid action from the Fed, and shortly thereafter there's some rate cuts, and that's obviously what the market is starting to forecast. But room to maneuver is more limited in Europe than the US. There's obviously some monetary flexibility there. Europe is in a slightly tighter corner from that perspective.
Yeah, and we have the ECB press conference a little bit later. What's it like doing business in negative rate environment? When will that change?
Well, when that'll change, I don't know, but it's obviously very tough for the big retail deposit-taking banks across Europe, and that's one of the issues that's impacting their earnings power and making it difficult for them to get the returns that they'd like to get. It'll be interesting to see what happens at the ECB today. Obviously, Draghi is coming to the end of his term, so everybody's looking to the future and who will be next, and so. Everything else being equal, you're unlikely to see big shifts right now, given where we are in that leadership cycle.
Richard, you have many chief executives from the insurance world, from the banking world here at the conference in Paris. What do they tell you that they're worried about?
Well, it's really growth and earnings power. On the one hand, the revenue line is challenged. There's limited growth across Europe. Negative interest rates make it difficult for them. On the other hand, costs are rising. You've got to adapt your business model. You've got to invest in technology in a significant way, and so the operating environment is challenging whichever way you look at it. So, there's one solution to this, and that is some consolidation and taking further cost out of the system. It still seems to struggle with that. We've obviously had an example earlier this year of potentially two banks in a domestic market getting together. That didn't happen. All sorts of good reasons, but if you can't get it done domestically, across borders is more difficult. But I think there'll be growing pressure for consolidation across the banking space. One of the requirements would be, certainly when you get to cross-border discussions, for banking union to be completed. And if there's one message to Brussels, get on with it. Let's get that done.
Yeah, I was going to ask you actually about why you were talking about Deutsche Bank, Commerzbank, which everyone was going to see as a catalyst to kind of this wave of M&A consolidation in Europe that didn't happen. So what's the next catalyst? Does it have to be the banking union, or does it have to be something else?
Well, the domestic consolidation doesn't need the banking union, of course. I mean, they could have done that. It'll be interesting to see how investors react. I start to see investor pressure on these institutions to move forward. You've started to see some bank consolidation in the US, and those are obviously strong institutions getting together. The investment spend and the scale required to invest, that's required to transform your business platforms, adapt to the new world, is significant, and scale is key to that.
Richard, how much time? Every time I speak to you, I ask you about Brexit. But
I thought we were through this interview without that.
No, it's always something about Brexit. Given that banks had to prepare for any Brexit scenario, does it mean, and actually move out of the UK or at least diversify some of the assets, does it mean that it could be easier if Jeremy Corbyn came into power for the banking?
It's a good question. I think the issue for us would be what impact is client base.
Yeah.
He's obviously not going to impact the European client base, and a lot of our preparations around Brexit were positioning the institution, Goldman Sachs, so that we could service our EU 27 client base, and we've made those adjustments and we're ready to go. We've made a lot of the moves, and the others we knew what the final outcome was. Any change in government, and you asked, the Corbyn government, that would depend on what is the impact on the UK client base. If the clients started to move, then we'd have to move more, and if those clients move to Europe, we'd be well positioned. But I suspect if they move, they'd move in both directions. Some would go back to the US, and obviously we're well positioned there. So it would be the client reaction that we'd be looking at.
What are clients asking about Brexit right now?
We're 3 years on, and we know no more than we knew 3 years ago. And so, the focus of client discussion now is about growing their businesses. I think Brexit is, people have adjusted. People are, I'm talking about at the big end. I mean, there are obviously lots of smaller companies across the UK that have not made the preparations, and there will be challenges there. But there are bigger issues than Brexit for our client base. How do you adjust? How do you grow your businesses? What are you doing on the technology front? What's happening in global trade? The U.S. China question. I mean, one outcome of that, of course, and if nothing does proceed and the U.S. China trading blocks start to separate, the imperative will be for the U.S. and Europe to come closer together. And that, again, can create opportunities and questions that people are thinking about.
So would it be U.S., Europe, China? If there's a school of thought that says if the Trump administration goes after China, then it's going after Germany and Europe next in terms of tariffs.
So we'll see. Look, Europe as an export bloc obviously exports first to China and second to huge commercial linkages, both ways, and obviously Europe will, serve to will try and preserve both of those. So it'll be very much tied up with geopolitics.
I know you look at the markets and you give good commentary on the markets. So I was going to ask you where you see I don't know if it's a bubble or something that will actually be repriced. We're looking at yields at 2.1 in the U.S., negative yields in Europe. Are you looking at currencies or equities to kind of give us a little bit of volatility this year?
Yeah, volatility would be good for some of our businesses. We've been living in a low vol environment for a long period of time, obviously. Looking at where markets are positioned, here we're not sitting in a place where people have been euphoric. If you look at outflows from the equity market, throughout the year, they've been very, very significant. In fact, the bid for the equity market has really been the corporate, buying back stock. So people are not overly exposed to the equity markets. The backup in the fixed income markets, changing rate expectations. So we're sitting in an interesting position. We obviously had a very long economic cycle, and there's no obvious reason why that cycle should end. Conditions in the U.S. economy continue to be good. Employment is good. If anything, there's going to be more support from the so economic growth continues because people are cautious.
Do you worry about China? Is that kind of the canary in the coal mine? That like the actual strength of the economy?
The trade question.
Yeah, the trade question, or just the fundamental economy.
If these tariffs, and I think the base case now is that you are going to get, let's say, 10% on the extra 300 billion, and that clearly has an impact. The 300 billion is the big number there. The 10% people feel you can adjust around. The question is, does it go beyond there?